In this video, I'm going to go over 5 different stocks that are my picks for the month from the 100 stocks that trade on TSX that I've looked into. I'm going to go over their recent financial figures, their valuation metrics, and provide my analysis on why they are my picks for the month, so make sure you watch the entire video. I'm also going to provide recent business updates so you get an idea of where these stocks are potentially headed next. Let's jump right in. First one up is Canadian National Railway, ticker symbol CNR. Here we go again. More volatility of CN Railway following the news that activist investors' proposed CEO, Jim Vena, is now out of the running. This stock plunged over 5% on the news, which I think is just absolutely crazy. Sure, there might be some uncertainty on who's going to take that top job, but I do think that the right leader will be found. It's just a matter of time. And once they're found, this stock will continue trending higher as it's done in the past. Let's take a quick rundown of the stats. The current stock price is roughly around $156 per share, has a market cap close to $111 billion, a dividend yield of 1.58%, and a sweet 5-year dividend growth rate of over 10%. Anytime I see a dividend growth rate more than 8%, I just get excited. In the last 1 year, the stock is up 12%, and in the last 5 years, the stock is up 71%. Taking a look at the analyst recommendations, it has a solid buy rating of 2.6, with 5 analysts giving this a buy rating. And if you take a look at that price target, you'll notice that it's currently undervalued as the current trading price is just below the average price target, meaning there is potential upside with a high price target of $187 per share. When you're looking for a stock, doesn't matter if it's Canadian, American, or international, you need to consider if that company is considered to be a leader in its industry. If it is, then it clearly has a competitive advantage over its peers. Take CNR for example, it is a larger entity as part of the duopoly that dominates the Canadian rail industry. With a rail network of over 33,000 kilometers, there is no denying the fact that CNR has helped build Canada to where it is today. This stock is known for delivering not only a strong top-line performance, but also for growing its profitability and strong cash flow. CNR has managed to increase its dividend for the last 25 years every single year. And despite all those dividend increases, the payout ratio is only around 36%. Consistent dividend increases, low payout ratio, a competitive advantage over its peers. That's the kind of dividend stock you just want to pounce on as soon as you get the chance. And looking at that low payout ratio from CNR, that means the company has plenty of room to continue growing its dividends as the years come. And despite all the advances of modern technology, rail is still considered to be one of the best and most cost-effective ways of transporting large goods across long distances. And as a result, the railway industry will continue to be relied upon for the foreseeable future. And because of the huge barriers to industry, there's a reason why this space is dominated by 2 key players. CNR stock fell to around $125 per share when merger talks with Kansas City broke down, but you can see how quickly it's bounced back since then. And here's my gut feeling. With all the chaos that CNR experienced in 2021, I'm sure they're going to make up for it a big way with a major dividend increase in 2022. And CNR is a very dominant player in its space. It generates healthy profits and plenty of free cash flow. And here's my personal take on CNR. Anytime I see a dip in this stock, I'm going to pounce. And it doesn't matter if you're a new investor or a seasoned investor. Considering this is a dividend growth rockstar, you want to pounce on the stock with every opportunity you get. Here's another fun fact. If you had invested $10,000 into the stock about 20 years ago, that same investment would be worth close to $200,000 today. Here's another pro tip. Buying the stock on dips generally leads to good, strong, long-term returns. And if you're new to the channel or you've seen my content before, do me a huge favor. Hit that like and subscribe button because it lets me know produce more content like this and you don't miss out on future stock picks. TD Bank, ticker symbol TD. TD generated major profits in fiscal 2021 and the trend should continue in 2022. There is a reason why TD is considered to be a top 10 North American bank. It's also Canada's second largest bank by market capitalization and has operations in both Canada and in the United States. In fact, TD actually has more branches in the US than it does in its home market. Here's a quick rundown of the stats. The stock is currently trading around $96 a share, has a market cap close to $176 billion, a healthy dividend yield of 3.7%, and a very nice 5-year dividend growth rate around 8.5%. Taking a look at the stock performance, in the last 1 year, it's up 34%. In the last 5 years, it's up 44%. Looking at the analyst recommendations, 3 of them have given this a strong buy rating, and 5 of them have given this a buy rating, giving TD a very solid overall buy rating of 2.6. And if you take a look at the price target, you'll notice that's right in the middle between its average price target and the high price target, meaning it's trading roughly around fair value. As both the Canadian and US economies are expected to grow in 2022, this is good news for TD's banking, commercial banking, and wealth management segments. And also keep in mind that interest rates are going up in 2022. The overall impact, when you consider all the factors, is going to be very positive news for TD and its shareholders, and secure better returns on fixed income investments. And here's a really nice chart I like to look at when I'm looking at TD. Back in 1995, TD's annual dividend was only 22 cents per share, and today it has grown to $3.16. That's an annualized dividend growth rate of 11%. And here's another neat fact. It has 164 years of paying dividends. Consider a 4% yield, a 40 to 50% payout target, and you can see why investors love this dividend stock. You'll find TD on every top dividend stock list, and now you know why. And more recently, TD just announced a distribution increase of 13% and a major stock buyback program. This bank is sitting on a large pile of excess cash that has built up throughout the pandemic. I have a gut feeling that we're going to see another major dividend increase in the first half of 2022. And I wouldn't be surprised if TD were to announce a major acquisition in the next little while to further drive growth. Even at the current valuation, TD to me looks incredibly cheap. We're on the cusp of a higher interest rate environment that will lead to higher net margins for the banks. Make no mistake, TD will continue to ride out the waves time and time again and come out a winner. Early next year, TD is going to easily pass the $100 per share mark because it's going to be a Goldilocks type of environment for all the banks. If you're looking for a sign to pick up more TD shares or to start a position in TD, well, here you go. Here's your sign. And you might be wondering, what is the best way to keep track of these amazing dividend stocks? You can now download my custom-built portfolio tracker and dividend spreadsheet that I built for investors like you. You can keep track of your dividend income, your gains, your losses, and the best part, forecast your future dividend income. Because of all the requests I received, I built it from the ground up and it's fully automated. I personally would not be able to manage my portfolio and bring it to where it is today without the spreadsheet. So make sure you download yourself a copy, link in the description. TELUS, ticker symbol T. TELUS is a no-brainer pick, especially in 2022. We have a 24/7 need for constant telecommunication services. And the second largest telecom maintains its dividend aristocrat status with 17 years of consistent dividend increases. In 2021 alone, investors were up close to 20% on this stock, not to mention a very attractive dividend yield of 4.5%. TELUS is able to grow its dividend due to its healthy balance sheet and executing on its growth strategy. Taking a quick look at the stats, the stock is currently trading around $30 a share, has a market cap close to $40 billion, a dividend yield around 4.5%, and a pretty good 5-year dividend growth rate at 6.28%. In the last 1 year alone, the stock is up around 15%. And in the last 5 years, the stock is up around 38%. Take a look at the analyst recommendations. It has a very solid buy rating of 2.1, as 10 analysts have given this a buy rating, and 2 of them have given this a strong buy rating. This stock is currently undervalued based on the current trading price being below that of the average price. And trust me, it's always a good idea to pick up a dividend stock when it's undervalued so you can ride the uplift. When it comes to the telecom network, TELUS has a coverage of 99% of the Canadian population. That may not be a big surprise to you, as it's one of the largest telecom companies in Canada. But what may be a surprise is the growth of its healthcare business. TELUS's healthcare business alone could propel it to new heights. And right now it has 2 key growth opportunities under TELUS Health. One is a business that provides services to healthcare professionals. It offers a suite of EMR solutions in addition to administrative and management solutions. By providing these type of services like telehealth, TELUS has been able to transform our very outdated Canadian healthcare industry. And the second key growth for TELUS is personal health. Through its MyCare app, patients have the ability to seek doctors, mental health counselors, and dietitians directly from their app. This allows TELUS to benefit from a rapidly growing telehealth industry. And not only that, but it makes it a legitimate leader in this field, as it's set out to be a trendsetter. It's disrupting the healthcare industry with telehealth. When it comes to Canada's telecom sector, TELUS is already set as one of the national leaders. And now when you add on telehealth on top, you can see why investors get the most bang for their buck when it comes to choosing TELUS as their go-to pick. You're just getting far more value compared to the other 2 telecom players. It's managed to become a telehealth leader. Not only that, but it's also grown its 5G operations ahead of its competitors. Its advanced fiber-to-home deployment has led to increased revenues, free cash flows, as well as a new additional customers. The company continues to beat its competitors to the punch, bringing in that free cash flow that will allow it to be a leader in its space for the years to come. And the best part, if you're the investor, that means more dividend increases for your pocket. OpenText Corporation, ticker symbol OTEX. OpenText is one of Canada's oldest tech companies, being founded back in the early 90s. It's a highly diversified tech company with multiple enterprise software offerings such as content management, data analytics, and digital media storage, and more. Basically, the company offers a variety of cloud and software solutions that allow companies to manage their content creation and storage. It's one of the very few tech companies that not only pays a dividend, but has been growing its dividend for the last few years. Taking a quick look at the stats, stock is currently trading around $61 a share, has a market cap close to $17 billion, a dividend yield of 1.88%, and a very nice 5-year dividend growth rate of 12.5%. And if you've been following this channel, you know for a fact that I love that double-digit dividend growth. In the last year, the stock is up 4%, bouncing up and down, but in the last 5 years, the stock is up 46%. Take a look at the analyst recommendations across the board with 7 analysts covering the stock. Each of them has given this a buy rating. It's a growing tech company. It's been growing its dividends. There's not much else to say on why this needs a top consideration for your portfolio. Not only has OpenText grown organically, but also through a string of strong acquisitions, one of which occurred on December 23rd, 2021. OpenText recently announced the acquisition of Zix Corporation, a leader in SaaS-based email encryption, threat protection, and compliance cloud solution for small and medium businesses. Financial projections because of this acquisition and updated target models will be announced by OpenText in Q2 of fiscal 2022. The total purchase price of this acquisition was $860 million, inclusive of Zix cash and debt. You have to love the business model for OpenText. It translates to a proven free cash flow generating machine. And investors love this. I love this because it churns out higher and higher dividends each and every year. And a little bit of a bonus that the dividend it pays is in US dollars. And it uses that free cash flow to make acquisitions, deleverage, and that cycle continues time and time again. And if you're interested in this Canadian dividend aristocrat that just happens to be a tech company, one option is to wait for that buy the dip opportunity. This tech stock has delivered growing dividends in each of the last 8 years or so, with an average annualized growth rate of around 13%. And because this tech stock provides dividend growth rate that's above average, your total return will come primarily from capital appreciation as part of the total return approach. Because there's 2 sides to total return. One is capital appreciation, the next is dividends. And over the next 12 months, analysts are projecting an upside of over 19%. Couple that with the dividend yield, and that will boost the near-term total return to over 20%. This is an amazing return for a lower risk investment with quality earnings. And if that was enough, OpenText has delivered a total return that was twice that of the TSX. Loblaw Companies Limited, ticker symbol L. The price of everything, food, gas, rent, is rising every single day. And this is not a normal surge, but a significant surge that's burning a hole in your pocket. You've likely realized that your purchasing power is falling seemingly every single day, and wages are just not keeping up. But here's the thing, even with the surge of inflation, you still need to eat and get groceries, and that's where companies like Loblaw's comes in. One of the best ways to take advantage of situations like this is in the defensive sector. You may be surprised to know, but this food retailer stock has gone up over 55% just in 2021 and is currently trading around all-time highs. Taking a further look at its stats, the stock is currently trading around $104 per share, a market cap close to $35 billion, a dividend yield of 1.4%, and a 5-year dividend growth rate of 5.7%. In the last 1 year alone, the stock is up over 63%. In the last 5 years, it's up 82%. Taking a look at the analyst recommendations, 8 out of 12 analysts have given this a buy rating with a total overall buy rating of 2.4. And with the current trading price below its average price target, that means this is another undervalued dividend growth stock. This is a great opportunity to pick up another dividend growth stock while it's undervalued. This should come as no surprise, but the stock market is full of ups and downs. Instead of focusing on the market noise, look to see the company's potential in the current environment. See if there's a material change in the industry that will impact the company's cash flow. If there's no material change in the cash flow, then stay invested. This will keep you calm during a bear market. And another thing that will build your confidence when it comes to the stock market is hedging your bets against inflation. A good inflation hedge in the current economy could be the energy sector or food retail stores like Loblaws. Loblaws is poised to take advantage of everything from gas and groceries to pharmacy and no-frills purchases. Loblaws is a grocery kingpin that's known for delivering returns to shareholders. In 2020, Loblaws announced a partnership with Gatik, a technology company specializing in autonomous vehicles for short-haul deliveries. Fun fact, Loblaws is a leader when it comes to using autonomous vehicles for commercial use in Canada. Looking at the environmental factors, the packaged goods industry is responsible for producing 1/3 of all plastic waste. Loblaws is eliminating plastic waste, eliminating plastic straws, plastic stir sticks. taking 1.8 million plastic hangers out of Joe Fresh operations, and much more. If a company wants to grow and attract investors, it must focus on ESG initiatives, just like Loblaws is doing. The Loblaws group of companies is expecting more and more customers will shop at its discount chains in the coming months as it continues to see food inflation continuously rise. Loblaws even raised its annual earnings outlook as third quarter earnings and profits beat expectations. There is a clear, robust demand for groceries and other essential items during COVID-19, and this demand doesn't seem to be going anywhere anytime soon. Do you have a stock in mind that I should feature in my next video? Let me know in the comments section, and make sure to check out my entire dividend stock series to know what stocks I've covered in the past. Thank you so much for watching. Make sure to check out all the links in the description, and I'll talk to you in the comments section.